The following was recorded in front of a live studio audience at the Studio 21 Podcast Cafe. This is the United Podcast Network.
This is Africa Diaspora Connect.
Join us as we take the journey from the motherland to America.
We share our experiences and learn from them.
Here is our host, Kibathi and
Welcome once again to Africa and Diaspora Connects, where like-minded, meaningful minds meet to engage, debate, provoke, and educate all in one. We're coming at you from Studio 21 from the United Podcast Network with my master producer, Ben Kitchen, at the helm. So, what's on our minds today? My guest today will take us into the underworlds of credit management. The do's and very don'ts. How do we best utilize that concept of OPM, other people's money, to stay ahead of this finance game? As mentioned in our highly rated podcast on taxation, we are clueless on financial-related matters, and yet we immigrated here to make this moolah, but we don't know what to do with it when we earn it, how to keep it, nor how to make it work for us in return. We are financially illiterate lot. Those are us. You need to sign up for these Gumbaru classes. How can we leverage this trust we call credit and make it work towards the advantage? You're laughing, right? So I have with me a very close brother of mine who justifiably refers to me as Uncle, yeah. Mr. Victor Rie is a husband, a father, a brother, and a credit repair consultant guru in and of itself. He is going to take us into that abyss of credit, that trust that we keep breaking over and over. Victor, karibu to Africa Diaspora Connects.
Asante sana. Thank you very much.
Sana. Did I mention he's one of my partners too? Yeah. So for those of us who have a bad relationship with their credit, all right, or those that are looking to build on one, this is your podcast to keep listening to. So you young adults who just got into employment, looking to, someday to get your dream house, this is the tutorial.
Right.
For our new immigrants coming into the settle in this +1, where cash is no longer king. Pay attention. And for those of you that are in the credit ICU, where Jeff Bezos himself, as a cosigner, a term we're going to talk about, will not manage to get you access to a gas station credit card, you need this podcast like you need oxygen. All right, man, let's get started, brother. Let's get started. Credit. What is credit and why is it so important?
First of all, I'd like to say I like your intro with saying credit ICU because a lot of people just look at their health, right? And this podcast, we want to look at your financial health, right? We also want to be healthy. You want to learn how to improve your credit and maintain it. So I like that headline. What is credit? So credit is basically just the ability for consumers to buy products and services and defer the payment. It's a concept based out of trust that the creditors understand that later, and they hope that later, the consumers will pay them.
Understood. So what determines a good credit report?
Okay.
What determines that?
So there's two things. There's a credit score and there's a credit report. So with a credit report, I would urge all the listeners today to always get your credit report annually. Every 12 months, you should get it. It's free. Just go to annualcreditreport.com. Every 12 months, you get it for free. It comes from the 3 credit bureaus. TransUnion, Equifax, and Experian.
TransUnion,
Equifax, and Experian.
Okay.
Right? Mm-hmm. And the one thing you're going to see in your credit report, it's not going to have a credit score on it. But what it's going to have your identifiable information. It's going to have your creditors on it. It's going to have your history. It's going to show you if you're late on payments or not. And the other better thing you want to see on your credit report is also who is pulling your credit.
Mm-hmm. So, at what age, where do we start? I have a kid in college right about now.
Right.
When do we start? When do you start to build your report, your credit? How young do you have to be, and how do you get started?
Right.
Like, Dad, what do I do? Where do I start? How would I answer that question? Because like I said, I'm as illiterate as the next guy, all right?
Right.
So talk to that audience, young adults, listen.
Right. So the thing is, with financial literacy, I would urge parents to start as young as possible, right? In America, we're in a society
But
where
parents are they're clueless. They're clueless.
we got to start somewhere. Just because you're clueless, you have to start somewhere, right? You got to start, like we coming from Africa.
Yeah.
We never get paid for chores, right?
Yeah.
Here, people get paid for, doing dishes or whatever. You give them that $1, $10, teach them how to save.
I don't pay anyone anything.
You're different, but some people do it. So you can start at an early age, but when you get gainfully employed in the U.S. at the age of 16, simple things you can do. Open a checking account and a savings account. With that, you get a debit card, right? With that debit card, the kid's going to start looking at the inflows in and out. It's so simple for them nowadays because they have apps. So quickly they made a purchase. You get a ding. You can see if it's you can see money going in, money going out, right?
Understood.
After they build a sizable amount of money, maybe $1,000, $2,000, then they can get what we call a secured credit card.
Secured.
Yep.
Okay. What is that?
So basically, you're just fronting the bank your hard-earned money, and they're giving you a debit card that's going to be treated as a credit card. So all rules will apply on a credit card on this debit card, including interest.
So wait a minute. So it's my money.
Right.
I have $2,000.
Right.
I go to my bank, whatever the bank. We'll mention names until they sponsor us. All right?
And I know they will soon.
They will.
Right.
So you're telling me my $2,000, I go in there and I get a secured card.
Right.
But the bank is charging me an interest rate to use my own money.
Because they want to use it the same way you would be using a credit card. Remember, this is just a way for you to start building your credit. Because you're not, remember, this kid is 16 years old? So you can't even apply for a credit card because you have to be 18 years old to apply for a credit card. So at 16, we are just trying to start, getting this kid.
Even at 19, I guess, right?
Or at 19, right?
Yeah.
So you have the secured credit card. It applies the same way as a debit card. It applies the same way as a credit card. So all rules applies. Pay your bills on time, right? We're going to talk about something called credit card utilization, right? You have this credit card for $2,000. The standard is we want to keep our customers, or you want to keep yourself at a credit utilization of below 25%.
We'll get to that in a second.
Right.
That, you are on point. We're gonna in a second. I know where you're going with that. All right. Let's delve into that. What are the key things? Let's talk about this whole thing about credit, all right? I hear something called, is it a FICO score or whatever scores? I don't know. I know nothing. Tell me about it. You talked about these three companies. Give me a little something. What's the best, what's health in credit, and when are you in Death Valley? How does it work?
That's a good question. So your credit score is just a 3-digit numeric number that creditors will look at to realize or to know if you're credit worthy or not. How are you going to pay your loans? How are you going to pay your lines of credit, right? So it ranges from 300 to 850, right?
I'm at 350.
At 350, then definitely you're on Death Valley right now.
Okay, go ahead.
Anything below 500, you're considered, high risk. I don't want to say bad credit, but it's bad credit, so high risk.
All right.
Anything between 500 and 650, it's fair. You might need a cosigner. All this, the first layer of below 500 and below 650, the interest rates are going to be high, right? Anything between 650 and 750, that's good credit. It's okay credit. Now, we want to get all of you to the 750 and above, 750 to 850. Excellent credit. You're not risk. You're dependable. I mean, the best thing about credit is with a high credit score, you have what we call access. So you have access to capital. You can buy a house. You can buy a car. You can pay for your college, for your kids to go to college. You can pay for your own self and get a student loan and go to college, right?
Other people's money.
LPM, you just mentioned it. So we are looking for ways to get access to capital, and the best way to do it is with a high credit score.
Okay. All right. Okay. We're listening. So we get that secured card. A typical kid starting off, first job. What's their score? Typical with no credit. Where do they start?
It's going to be below 500. You have nothing.
Below 500.
And it's just not a typical kid in high school. So even people immigrating from different countries coming to the U.S., you don't have any, you might be 40, and you don't have any loans, you don't have any credit, you don't have no history. So, and I think we can go into the 5 ways on
Let's go there.
So
absolutely.
The best way to look at it is look at your hand. You have 5 fingers, right? So your credit report is divided into 5. The most important thing, which has 35% on it, is your credit history.
Okay.
Right? How are you paying your credit? How are you paying your loans? Are you paying them on time? If you're not paying your debt on time, that's the biggest reason, that's the largest reason why your credit would drop, right? The next one is 30%, is how much debt do you owe, right? And this is where we're going to go into the credit utilization rate. So you have a credit card for $5,000. We typically like to see a utilization rate of less than 20% or 25%. What does that mean? If I have $1,000, I'm not spending more than $250. Studies have shown, and we've seen with our clients, any person who has a credit between $800 and $850 has a credit utilization of less than 7%. It's not that they don't have the money, they just have to use the card for a revolving credit. So keep your credit utilization as low as possible. That's 30%. The other 15%
30, 35. Now we're at 65, right?
It's 65.
All right.
If you don't do anything else, just get those two, and you get some traction going.
Okay.
Right?
All right.
So 15% is going to be the history of debt you have, right? And we typically want to see 9 years of this. So I get a lot of questions in regards to this because somebody will have a card where they've messed up on and they really want to cancel it. And the first question we ask them is, when did you open this card? If you opened this card 10 years ago, 9 years ago, 7 years ago, we will work with you to restore your credit, but don't cancel it, because once you do, you've wiped up all your history. So you is as good as just somebody who just started earning credit, or somebody who just came from a different country to America and just used stuff from scratch. The other two portions, it's 10% for credit mix, and what we want to see is a variation of debt, right? We just don't want to see Kibathi with just 16 credit cards and nothing else. We want to see, you have a mortgage, you have a car loan.
But that used to be the thing. You used to go into your wallet. Nowadays, you look at the typical, one of my guests, I'm sure if I go into your wallet, you guys have like 10 credit cards in there. Why are you carrying 10 credit cards? Why is that?
I feel like this is one of those traps we fell into when we came to the US, and we just didn't know any better. We went to, I went to college, and on one day you would get 8 different credit card companies. All you had to do is just give me my social security number and a sign. And literally in one day I can walk away with 6 different cards. Each card with 5,000, so I have 30 grand. What do I do with it? I don't even know. So what do I start doing? I start swiping and buying clothes, going on movies, going on cruises, vacation. I max it out. I don't know nothing about utilization. I'm in trouble.
So you're not a superstar if you have 10 credit cards?
No, you're not. You got to have a good mix. You got to have a good mix.
You got to have a mix.
And the last one is, how many times is your credit being pulled?
Okay.
Typically, we want to see 3 pulls in 24 months. So every time...
3 pulls in 2 years?
24 months, yep.
Oh, okay.
Yeah. Think about it, just a revolving 24 months.
Okay.
Because if you say 2 years and then, you have... Yeah, 2 years. So every time you get a pull, there's a difference between a hard pull and a soft pull, right? A hard pull is when somebody wants to give you a line of credit or a loan. They want to know, can Kibathi pay this debt? To validate that, they're going to have to do a hard pull. A hard pull can reduce your credit score by 5 to 10 points. So you got to be careful. If you're going to do 3 in a year, on the higher side, that's 30 points, right? Then we have something we call a soft pull. A soft pull is when, nowadays with all our apps, we have our banks giving us our credit reports, right? So they do that report every month. That's a soft pull. When you look at your credit, that's a soft pull. When a company like ours does, we do credit counseling, we pull your report, that's a soft pull. That does not affect your credit score.
All right, you heard it here. The Africa Diaspora Connects. We are teaching you on how to handle that one pitfall that we never ever get to learn, and we learn the hard way. Moving on. So, store credit, all right? You go to a Macy's, especially I'm talking now to our daughters, all right? They like to shop, and our wives and our sisters, all right? They're into shopping big time. Oh, yeah, you're going to save you 20% if you, we let us apply for this card. And, oh, my God, I have a $300 bill. You're going to take 20% off right now if I sign for this card? Hey, why not? Why not?
Run. I'd say run.
Why? I'm saving 20%. Why am I gonna? Why am I running?
It makes sense, right?
Okay.
So, give you a scenario. It's Christmas time.
Yeah.
You're shopping for your family and your friends, right? Your bill comes to $1,000.
That's too much, but it's okay.
Right. It's an example.
All right. Okay. All right.
So they tell you the same thing. We're going to give you 20% off. Not a bad deal, right?
$200.
$200. Not a bad deal.
Yeah.
But you don't know so the limit they're giving you for a limit of $1,000 is for people with good credit. Do you even know your credit when you go into the store? Maybe you do, maybe you don't, right?
Probably don't.
So what are they going to say? They're going to assume you have good credit. And they're going to say, hey, listen, you can qualify for $1,000. We said, okay, sign up for it. They come back, say you have fair credit or bad credit. They'll come and tell you, okay, fine, you've not been approved for the 1,000 as we promised. We got you approved for 500, right? So one, they pulled your credit score. So what's happened?
Ding.
10 points, right?
Got hit, 10.
You didn't qualify for the full amount. You had 500. So they tell you, listen, pay off the 1,000 with the 500, right? And then you can just pay out of pocket for the other 500. What's happened now? Now your utilization rate has gone to 100% because you've taken the card and you've paid the whole amount.
Oh my God!
Right? Only to find out when you get your bill, because you had poor credit, your interest rate on this credit card, on this debit card or store card is now 27, 29%.
Oh, what?
So it's just a lose-lose. I have nothing against store credit because I was a victim of them once. I swore I will never get that again. All I would say as an advice to the young people, to our ladies who want to go to the stores and buy is, first of all, understand your credit, right?
Understand credit.
I know this might be a hard question for them to ask, but if you can just ask them to let you know if there's a criteria. Remember, we talked about the different criteria of credit.
Who are they asking? The cashier?
That's the salesperson.
Cashier?
They might know that information.
Those are jokes.
This is the thing. If you're asking somebody a couple of questions and they don't have the answers, they just walk away. You don't really need it. You have
Basically
the money.
Basically run. Don't ask questions. Just run.
Yeah.
Run.
My experience and experience I've seen with most of our clients is it's unless you really have good credit. Initially you had the money to buy it. Unless you have good credit, you don't know what's on the other side.
You don't.
You only know when you get your first bill. Yeah. And I'm telling you, it's going to be a high interest rate. It's going to be high utilization rate.
What I'm hearing is this. We need to get away from one thing. Instant gratification. That is the cancer that's killing us.
Right.
We want it now. We want it here. We want it now and here. Let's honestly forget that. It's all about delayed. Is it a need or is it a want? And I think that's what traps us, right?
Right.
A need versus a want. It's like, okay, you can get 20% off. And you can even buy more stuff. I'm like, okay. That mindset.
Right.
Okay, let's go back to your credit counseling.
Sure.
Okay, I'm one of your patients. All right, I have my 400 score. I'm coming. All right, I have 400 and going strong.
Right.
All right, so how do you fix me? How are you gonna fix this guy in the ICU? What do I have hope? Are you gonna, what's that thing called? The defibrillator.
Right.
Financial defibrillator that you have.
Everybody has hope. Everybody has hope.
All right, thank God.
The one thing we've realized with a lot of people, especially in the diaspora, it's an issue of two main things. You have a lot of debt because you're living way above your means, and you're not making as much money, right? It's just two things, right? We have a concept called TIE, TIE, which is we teach our
TIA?
TIE.
TIE. Okay.
So we teach our clients to live with us on this concept. Once you get your paycheck, Uncle Sam, and we have some tax guys in the audience today, Uncle Sam will take your 30%. They don't trust you, they'll take their money. So why don't we do the same?
Uncle Sam is not trusting you with your own money.
They don't.
I've never thought about it that way.
You get your paycheck, you thought you made $1,000 a week.
Yeah.
When it goes into your bank account, it's $700.
Yep.
Right? It happens. We've all experienced that, right?
Yep.
So they take their 30%. Why don't you take your own 30%? Right? Save 30%. Right? So now we're at 60%. You're left with what? 40%, right? If you can't fit your expenses and the 40%, you're living above your means. So you got to do two things. You got to cut your expenses or you got to make more money.
So I'm hearing discipline.
Right.
Which is the hardest thing known to mankind, discipline. You're going to say something.
No, I was just circling because I'm like, I struggle with this too. So it's not an easy concept. And I was just saying initially, if the 40-40-30 is too strict for you, just adjust a little bit.
Yeah.
But leave within your means.
That's the key thing. Live within your means. I have a scenario, okay? I have perfect credit. I'm at 750, all right?
Right.
All right. I have a thriving business. I have a car loan. Not too much left in it. I got some credit card bills. Right. I'm looking to buy a house, okay? I'm looking to purchase a home.
Right.
And someone comes and tells me, hey, listen, go wipe out all your debts. You wipe up all your debts and you pay off your car, you pay off your credit cards. Then your score dipped. This is a real life scenario. It dipped from 750 to 675. I just paid my debt. I paid everything up. I mean, what am I missing here?
That's unusual, but what I think is missing there is even with the credit bureaus want to see what we call as, even if it's a small revolving credit, right?
Okay.
So even though you have $10,000 in credit card debt that you've cleared off, just use it, just get gas or something. Keep it open, keep it active, keep it revolving,
So you're screwed if you have that. You're screwed if you don't. When you it's this system. Can we sue them? I mean, how can you win? It's like loan sharks. I mean, this thing is.
I don't think you can sue them, but those are the games of the rule, man. You just
discipline.
You just have to
discipline. Guys, listen to this. Listen to this. You have to be in debt. Sounds like you have to be in debt, but you have to pay attention. We have to pay it. That's what I'm listening to right here. How about people who are just making the minimum payment? You're doing well. Your utilization is fine. Okay, your utilization is at that percent you said.
Right.
But they're asking for $10 a month. I'm only paying $10 a month. Can I pay more? I mean, what's your take on that?
Of course. Remember, 35% is paying your bills on time.
Yeah.
If you fall on hard times and there's nothing else you can do, pay that $10 on time.
Okay.
But understand, that's interest. It has nothing to do with what you owed.
So, because this is the thing.
Nothing.
Yeah, this is the thing. So you have $100, right?
Yep.
You owe $100.
Right.
They're asking for $10.
Right.
You pay $10 and you still owe $95.
It's the interest. So how they calculate it's 2% of what you owe. That's going to be your minimum.
Yeah.
Right. And that's what you're going to see on your credit card, on your statement. They're going to say this is your minimum, right? If you're falling on hard times, gotta pay that minimum, right? Mm-hmm. However, if you can pay more, pay more. You own the debt, so pay it.
Don't forget to pay on time, and if you can pay more, do it. But always have something left in there, revolving debt.
Right.
All right? Let's talk about debts.
Right.
I hear there's good debts. I hear there's bad debts. Can you walk us through that scenario? Good versus bad, and why?
Right. We call it the big D.
Big D.
And in this COVID times, D is for debt, right?
Okay.
So.
Okay. Thank God for clarifying that.
D is for debt.
Okay. Man. Thank you.
So we're going to simplify this the simple way, the simplest way possible, right? Good debt is going to be low interest, fixed, that increases your net value or your net assets. Simple as that.
Say that again, one more time.
It's going to be low interest. It's going to be fixed. It's going to increase your net value and net assets.
Okay.
All right. Bad debt is going to be
bad
high.
D.
Bad D is going to be high interest, variable interest, which you spend on depreciating assets like clothing.
Let's go to good debt.
Right.
Give us an example of
good debt.
Yeah.
All right. A mortgage is a good debt. Why is it a good debt? Low interest rates. Right now, we are seeing the lowest interest rates we haven't seen in a long time, right? It's fixed, right? And once you buy a house, you're sitting on equity. There's nothing wrong with that, right? That's good debt. Talk about a student loan, 4 to 6%, not too bad.
I'm scared of that topic. Go ahead. I'm scared.
Well, you're investing in yourself.
All right. What if they don't get jobs? Okay, go ahead. Just go ahead. Go ahead.
So that's another topic, right? So 46%. So it's low, it's fixed, and you're investing in yourself. Hopefully, you graduate, get a good job, and you have a higher potential of earning. SBA loans, same situation.
SBA. Oh, we had that. Yeah. Okay.
SBA loans, 2 to 3-4%. Fixed. Helps your company grow, right? You get more revenue, increases your net value. So simple, right?
Understood.
Bad debt.
Yeah, my son likes Adidas. These Jordans and latest Jordans. They cost $250. Man, Mike, if you're watching that, Mike's gonna watch someday, man. You're killing me, man. Go ahead. Yeah, bad debt.
Bad debt.
Yeah.
High interest, variable. Used to buying depreciating assets. Some credit cards. Store cards, definitely, right? I'm not saying don't get them. I'm just saying you have to be aware of what you're getting yourself into, right? So there's some debts that fall into a gray area, and the gray areas are like an auto loan. Living in America, you understand that you need a car, right? To move from point A to point B, to make a living, you need it. But again, you understand that car is a depreciating asset, right? So this is in a gray area whereby you need it, right? But it's a depreciating asset. Now, the other tricky part is you have to buy a car of your, I don't know how to call it, a caliber or whatever. You can't be a guy working for a grocery store, earning, I don't know, $100 a week or so, and you want to buy a Range Rover.
Why not? So all right, we'll get into that.
Yeah. I mean, you can.
Yeah.
You can, but you're going to just be working for that car.
Yeah, and there's this thing about buying old versus new. Buying a new car, I heard, is the worst thing. It's a topic for another day, but I understand as soon as you leave the showroom, that thing depreciates like God knows. You know what I'm saying?
Right.
So that's a bad debt. So a car is a bad debt. So listen, car, bad debt. All right?
Great debt.
Great debt.
Yeah.
All right.
Great debt.
Okay, one of the above.
Because you'll need it. You'll need it.
Yeah. Yeah, but it's a need or a want. All right.
Right.
Okay, let me give you a scenario then. All right, there's Victor here. He's established. He's a credit counselor, right? He knows his stuff. All right, and there's this young guy who's 25, just graduated, 23, great job, engineering, making good money.
Okay.
All right, and just like, I've been working so hard, studying all these 4 or 5 years, and I have this amazing offer, and you both get you've been doing this for a minute, you're established, you know your stuff. You both go out there and buy this fine Lexus, okay? Mm-hmm. You have it, and he's like, listen, what? That's what I want. I deserve it. It's my a graduation gift to myself.
Right. Victor
goes in there. It's $30,000. Victor puts down $10,000, payable in 36 months. I'm like, listen, Mr. Salesman, I can afford $300 a month. I want that same car, but only can afford $300 a month. I got banked. You saw what I got. You know what? I got banked. I got a good job and what have you. And it's like, okay, fine. They tell you, they go back to, all right, fine, Mr. Young Adult. We can get you this car for $300 a month. Easy. Like, yeah, go for it.
Right.
You pay it over 84 months. All right, that's cool. Let's do this thing. I'm driving the same car as Victor. He's been here for 30 years. I'm like, Victor, how'd you like me now? All right, can you walk us through that scenario? Because that scenario is prevalent.
Yeah.
What are we missing from that scenario? What would you advise this young brother out there who just feels like, I've arrived?
Right.
Yeah.
So the one thing we have to move away from, and you mentioned it, Kibathi, is looking at that monthly statement. Monthly payment. I don't know why we get so stuck on this. I mean, maybe it's a budgeting thing. So you want to make sure, like, in my budget, I can only take $300, but that's what we go in with blindfolds on, saying $300 is what I want to see.
Yeah.
Some of the questions you need to be asking yourself or asking the lender is, what's the interest rate? What's the repayment period? Right? Do I need to put money down? Right? Those are the things we need to start focusing on. Because, yes, I'll give you give me an example of myself and the young fella, right? Mm-hmm. Maybe we'll both get a payment of $300. I'll pay mine faster, which means I'll pay a lower interest rate, right? Mine was 36 months, as you said, mm-hmm. right? His was 7 years. Mm-hmm. So for another 4 years, you're just paying interest, mm-hmm. right? So I think we should move this from this mindset of just getting fixated on how much do I pay a month, mm-hmm. to start asking questions of like, okay, fine, what's the interest rate, right?
What's the end game? At the end of the day, how much are you paying? Because for that $30,000 car, you're going to end up paying maybe $33,000, $34,000.
You're going to probably interest pay another car and a half.
I'm going to end up paying $40,000. It's about the end game.
Correct.
We go back once again to something that I think we should really push into. This thing called instant gratification is the number one thing that's just knocking us out silly when it comes to our finances.
True.
It should be delayed, if you ask me.
And if they were using the time methodology that we spoke about earlier, they would understand they can't even afford it right now.
Yeah.
I know it's a graduation present, but if it's not in that 40%, forget about it. Forget about it for now.
Yeah. All right. So now, another scenario I would like us to give us.
Well, you have a lot of scenarios.
I guess I'm a man of many scenarios, man. They call me Houdini.
I like them.
They call me Houdini,
you know.
This one I was going to talk about is collection calls, all right?
Right.
That's the worst feeling in the world. I've been hit with collection calls. Listen, I've made all my mistakes.
Right.
How do you handle this? I mean, how you handle this is don't get into that. Okay, make sure you stay away from collect. But do we have any rights as consumers to deal with these collection calls?
Yes, you do. Now we're going to just quickly go over 4 of them, right? The first one is you have a right for them not to call you. You can just write them a letter and say, stop calling me, and going forward.
Can I curse? Can I curse at them?
Well, that's your discretion.
Oh, okay.
That's up to you.
All right.
But you can write them a letter and say, stop calling me, and going forward, just let's communicate on mail. Okay. That's fine. Mm-hmm. They cannot call you between earlier than 8 a.m. and later than 9 p.m. That's your right as well. They cannot call your place of work. That's the other one. So if you tell them, hey, if you get on the call with them, you sound like somebody who's informed, you know your rights, write them a letter, say, going forward, we need to communicate by mail, then reach out to a counseling service. And we will work with you, and we'll make sure we sort out any credit issues that you have. But with collections, I know the anxiety that goes with calls. You look at the phone, you can't even pick up the call. Your brother calls you with a different call ID, you can't even pick it up because you don't know who's calling, right? That's right. Just to get over that hump, stop the calls, and then let's work with a collection agencies and find out how we can get you out of that situation.
Guys, I hope we're paying attention. It's a journey. There's so much to cover. There's so much to talk about. But let's start with the basics. That's what I'm hearing right now. It's the discipline. And it's something I think we should start figuring out how to bring into discussion within our homes. But if you don't know, you know. But we have our champion here. Right. We have our guy. I'm sure you can see his information over there, man. He will take you from here to the promised land. This is only part one.
Well, I'm not Moses.
Oh, well. You better be Moses when you're on my show. Well, this is only part one. I mean, we're going to bring in things like bankruptcy. We're going to talk about the do's and don'ts of bankruptcy and how to deal with that kind of crap. Right. Should we do that? Do we don't? We're going to bring up stuff that, as I'm thinking, how long does it take? What's this 7-year rule? Before I go, what's this 7-year rule when it comes to your credit? Can you walk through that?
It's just a statute of limitation.
What is that?
So after 7 years, if you had something, a bad inquiry, a bad debt on your credit score, it should be able to be taken off.
Oh, okay. It vanishes into thin air.
Yeah.
So wait a minute. So what if, on my 6.5 year, I get a call saying, hey, listen, you got to pay this money. We're going to take you to court. What should I do with that letter?
I would say you've been holding off for 6 years, so what's another 12 months?
All right. Hey, listen, I'm asking questions. You are the Moses. You are the Moses, man. Victor Rie. Guys, we are learning a lot here. Right. This has been tremendous, man. We're going to come back with more in-depth stuff, Right. So I think today, we have hit on the demographics of new kids out of the block, young adults looking to start to build their credits. Right. I think we've touched on folks in their middle-age years coming in from the motherland, coming into this +1 where cash used to be king. It's not anymore. Right. Credit is king. Right. You heard that here. And we have talked on those of us who are dysfunctional in the ICU where nobody wants to touch us. Right. All right. And part 2 is going to be at another level. So guys, don't forget to like the episode, subscribe to the channel, and hit that bell icon, ding, so you can be informed when every episode is posted. The bondsman is revving to go. Africa Diaspora Connect, ICU credit. We are healed, brother. We are healed.
Thank you.
There we go. Thank you.
Welcome to good health.
All right. Thank you. All right.
The views and opinions expressed by the hosts, guests, or callers of this program do not necessarily reflect the opinions of the Studio 21 Podcast Cafe, the United Podcast Network, its partners, or affiliates.